So welcome everyone to Chapter 12. I'm going to do my best to do the entire thing in the time we have left. We should be able to because a lot of this is going to be review. So we're going to talk about all the complicated family situations that happen when your family size changes. We've already done getting married and establishing common law. We're going to talk a bit more about separation. We're going to spend a lot of time on support payments, and support payments received and support payments paid. We're going to talk briefly about adoption expenses. We're going to spend more time on child care expenses. We're going to talk about how personal amounts interact with each other a little bit, and then we're going to do a very brief what happens to GST benefits and Canada Child benefits when they're shared custody. I'm going to add climate action incentive because they've changed the rules on that as well. So here we go. Change of marital status. You already know this. If your marital status changes, it affects your personal amounts and your tax credits. It affects your benefits. You have to notify the CRA of change of status from Form RC65. Okay. If you've changed your name because you got married or you changed your name because you got divorced, you have to inform the CRA of the name change. We'll teach you how to do that on the tax return later. Okay. Just a quick refresher. How long do you have to notify the CRA after a change of marital status? So when do you have to file the Form RC65? What is the due date? So if the change of marital status happened, so right away after it happened, but the end of the following month, okay? If you separate, how many days do you have to be separated before you qualify as being separated? So how many days do you have to wait for the separation to count? Has to be 90 days. Good. So this is something I find students get confused about. So if you separate, let's say I have a client who separated on June 1st, and then 90 days have passed. So now we know the separation happened. Now we can file the RC65 by the end of that month. Okay. But what will the date of the separation be on the RC65? So they separated on June 1st. We've waited 90 days so that the CRA will agree that they're still separated. The date will be June 1st. That is one that people get confused. The separation started on June 1st, and the RC65 notifies the CRA of it after the 90 days are up. Good. Separation can cause problems for our clients if it happens at the end of the year. So think about a client who separated from their partner on December 1st, and they're coming in, and it's the beginning of February, and they want to file their taxes. At the beginning of February, what do we have to say their marital status was on December 31st? Because 90 days have not yet passed. Let's say they were common law or married, either one. They're still common law or married. But a couple weeks from now, if they filed a couple weeks from now, what would their marital status be for their 2021 tax return? Separated. So what do we do in that circumstance? Well, honestly, the easiest thing to do is make an appointment for them for the week after the 90 days are up and do the return that way, rather than filing it now and then fixing it later. Okay? You can't file it as separated if the 90 days haven't passed. And I'll give you a really good real-world example of why. My very first year doing tax returns, one of the first tax returns I did in an office, I had a young gentleman come in. He wanted me to do his taxes. I noticed that he had been common law with another person for over a year. So they had filed as common law in the past, and he wasn't filing with her. And I said, what happened? And he said, over the holidays, we broke up. I've moved out. I'm never going back. I want to file as separated. We're definitely not together. 90 days had not passed. He wanted to file that day. He would not wait. I said, the only thing I can do is file you as still common law, but we can do an adjustment if that changes and go back and fix it. So I can do a change of marital status afterwards, but you're going to have to file you as common law, and you have to claim everything that way now because you haven't been separated long enough. And I said, you can wait if you want to wait and come back. And he says, no, I want to get my taxes done now. So I said, that's what I can do. That's how we filed his taxes. A week later, a lovely young lady comes in, wants to do her taxes, lets me know she has a common law spouse. He's already filed his return. Guess what? Her common law spouse was the young gentleman who had said that they were separated, never getting back together. They got back together. So she moved back in, or he moved back in, whatever happened. They were definitely back together. She was not letting that relationship go. She's like, oh yeah, no, he had some crazy idea that he was moving out, but I fixed that. He's back again. Off we went. And they're still common law. So if I had filed him as separated, that would have created a lot of problems. If you don't wait the 90 days, you don't know if they're going to be separated at the end of the 90 days. So your options are file as they are and do an adjustment after, which I don't recommend. I try really hard not to do that. Or convince them to wait if you can convince them to wait. Once the 90 days are passed, they are separated. Then you can file the Form RC65 and you can file the tax return with the correct status for the end of the year, which, if the breakup happened before December 31st, would be separated. Okay. What's the difference if people get back together after a separation between being married and being common law? So if I'm common law with my partner and we don't have a child, and we separate in February, and then we get back together in October, what will my marital status be at the end of the year? Separated. Good. Even though we're back together, separated. Now, Lee, you're correct. Clients may prefer to say single in that circumstance, and sometimes after people get divorced, they get tired of writing divorced every single year on their tax returns, so they switch it very quietly to single. Technically, you're only single once in your life, and after that, you're either separated, divorced, or widowed, but a lot of clients will kind of drop that and go back to single. Okay, but they're definitely single or separated, and the 12-month starts over, so they have to wait till next year to become common law. What if they were married and they separated in February and got back together in October? What will their marital status be at the end of the year? Married, because they're still married. So that is the fundamental difference between being married and being common law from tax return perspectives. There is no real other difference for spouses. Okay. And this can get messy. So I did have a client who did not understand how RC65s and benefits and all of that stuff worked. We got her later on, so she had had her returns done for a number of years. And then what actually happened in this case is her daughters came in with her to file, and they said, we think that this has been done wrong and we want to get it fixed. What had happened was, like 10 years in the past, she had 2 young children and a husband, and they separated and he moved out. So she filed her return the year they separated as separated, but he filed it as married because he felt, and I don't know why he thought this, but he thought if I file as married, I might get some extra benefits, so I'm going to file as married even though they're not living together and their relationship broke down. The CRA sent her and him, both of them, a letter asking for clarification of their marital status. And because she had never gotten a divorce or a formal separation or a court order or anything, everything was just kind of the thing that happened, she thought that meant she had to file as married. The problem is this happened after she had received a number of benefits for being a single parent because she had the children. So she had filed else dependent amounts. She had received a few benefits based on the fact the children were with her and she was a single parent. And the CRA asked her to pay it all back, and she couldn't afford it, and so she had a big tax debt. What else did she not receive for a number of years, given that her ex-husband, who was not living with her, was still saying that they were married on the returns, and he had a high income, and they had 2 kids. He wasn't paying any support either. What benefits did she not receive? Canada Child Benefit. In her case, she didn't receive Canada Child Benefit for over 7 years that she would have been entitled to. And she still had this big tax debt hanging over her and was making small payment plans and all of those things. So what happened in this case is her daughters had grown up to the point that I think one of them was 18 and one of them was 16 or 17. And they said, we think this was done wrong and we don't know how to fix it and it's really messy and what can we do? There's nothing in writing. So in that circumstance, we had to show evidence that they had been separated for a period of time. What was the evidence we had? What can you do as evidence to show that? There's no court order. There's no separation agreement. If you could show that he was paying rent or utilities or other things in another place, now, he would have to cooperate for that. In this case, we were able to point out that he had been living at different addresses and CRA records were different addresses for like a very long time. And the daughters actually went to their dad and said, you need to fix this. We need some utility bills. We got utility bills for the year the separation happened and a handful of utility bills for like years after that just to show that they didn't get back together. Obviously, we couldn't get utility bills for the entire period that they had been separated, but enough to show there was a pattern. And a statement from the mother and a few statements from other witnesses as well. So the school, the doctors, everyone who knew that she was basically a single parent through that period of time, who were not related to her and therefore likely to lie. We got all of that put together, got it filed with the CRA. It took almost 2 years to get everything through because they really did investigate in it because it was so many years of it being messy. At the end of that, not only did they reverse all of the debt for her and repay the repayments she had made, she also got her CCB for all the years back that she should have been getting. So separation doesn't always happen on paper, but if it does separate, you have to make sure that you have evidence that you're no longer living together. Okay? And yeah, wonderful kids. She had very good kids. Okay? So getting married, we know the rules for getting married. I'm not going to review those. I assume you're good. Separation in the year. Separation has to be because of a breakdown in the relationship, not because of a health issue or a job opportunity, but you're still together. That doesn't count as a separation. Okay? It can be written, but it doesn't have to be. If it's not written, you're going to need some proof. It gets tricky if you have two people who live in the same house and now they hate each other, but they don't move out. So we do run into gray areas or messy situations where they really should be filing as separated because they're definitely not together. They're not cooperating. They can't stand each other. But for whatever reason, they're still living in the same house. It becomes difficult to prove to the CRA they're not together. So life gets messy. Taxes get messy. There's usually some documentation you can get to say otherwise. But remember, lots of people would claim as separated if they could for tax purposes because they think they're going to get more benefits. They think they're going to get elder dependent amounts. They think they're going to get more Canada Child Benefits and other things like that. It usually doesn't work out. But the government will be a little more suspicious of people who have had a relationship breakdown significant enough to count as a separation who are still in the same house and sharing finances. So Judy, you're told if you both live in the same house, then you're common law. Generally speaking, the assumption will be that unless you can prove otherwise. We've had a few scenarios where the house is separated into two separate apartments and the downstairs apartment isn't sort of accessible to the upstairs apartment, so it is functionally two different units now. We've been able to be successful in getting a separation on those terms, but definitely if you're sharing living expenses and finances, it's a little bit harder to say that you have actually completely separated. So it can get messy and there isn't always a good answer. Okay, so RC65s are always sent the month after, by the end of the month after the change of marital status happens. But remember, you need the 90 days to pass for a separation before you can file it. So if it's a separation that you're reporting, you have to wait 90 days first and then file the RC65. Don't send it early because they won't accept it if you send it early. All right. So that will tell you if you are separated or not separated. We're going to have some credits where Separation is going to be important, so you'll have to know what counts as a separation. I want to talk about support payments next. Now, for this, I want you to remember the rule we have, which is every line on a tax return has its own rules. For the next chunk of time, when I say the word support, I mean support that goes on the tax return as reportable and possibly taxable, support that goes on the tax return as reportable and possibly deductible. There are lots of other places on the tax return where we talk about support. Eligible dependent, we talk about support that you get because it's not from a written court order or agreement. We talk about support for dependents. Don't mix these rules up with any of those. These are completely separate. So if we're going to put support payments on a return, then we're talking about two specific lines, and all the rules I say are going to be for those two specific lines. So after you separate or divorce, you might have an order or a written agreement for support to be paid for the spouse, the sort of maintenance and upkeep of the spouse, or for the children, or a mix of both. Okay. If it is something that falls in all the rules I'm about to teach you now, it must be reported on the tax return. And some of it might be taxable, some of it might be deductible. Okay, we'll talk about what it is. If you have a written agreement or court order and it specifies spousal support, you must file a T1153. You have to have that on file. Who is voluntarily going to tell the CRA that there is a support order? The person getting the money or the person paying the money? Who is going to come cheerily into your office and say, I want you to file the form, where's the form? The person paying will definitely want to do it. So if you have someone who is paying support, they will come and ask you to put deductions on the return. They'll tell you all the support they're paying. The person receiving the support will probably not volunteer that information, either because they don't want to report income, or they don't know they have to. They don't realize that they have to put it on the return anywhere. So if you have a client who is a single parent, or you have a client who is, I'm going to say, relatively recently separated. If they've been separated a long time, they're probably not still getting spousal support. Maybe don't make assumptions and ask anyway. But if you have someone who's separated or divorced, whether there's children or not involved, you need to ask them if they have any support that's coming from a written agreement or a court order. Because if there is, it may need to go on the tax return. Okay. This is missed because we don't ask the question often enough. We should ask it all the time. Okay. When do you have to report support payments and how do you do it? So, how to do it first? All payments received, whether it's taxable or not, if it follows the rules that I'm about to tell you, so if it qualifies as support for these rules, it must be reported on line 12799. If there's a portion of it that's taxable, that portion will be reported on line 12800. So 12799 is a reporting number. It's on the left side of the return. It does not change the numbers. 12800 is taxable income. It goes on the right side. Okay. And then if you're the one paying, all the support payments you make, again, only the things that fall under these rules have to be reported on line 21999. And if any portion of it is deductible, it's deducted on line 22000. Okay. The next set of slides, and I'm going to warn you, when you get your slide deck, these are not in the order that they're going to be in the slide deck. I have moved them around to make them more efficient and organized to teach. I want you to mentally add another word to this slide. It says taxable/deductible. I want you to say reportable, taxable, and deductible, because these rules will tell you if you need to report it, and then after you've reported it, it will help you determine if it's taxable or deductible as well, because sometimes you have to report it, but it isn't taxable and deductible. So add the word reportable to this slide, and let's go through. For support payments to be reportable and possibly taxable or deductible, they must be paid because of a court order or written agreement. So this has to be in writing. If it's not in writing, we're not putting it on the return. Okay? It has to be for the maintenance or benefit of the former spouse or common law partner, or the taxpayer's children, or both. So it has to be going to one of those people. And the recipient and the payer have to be living apart at the time the payments are made. And again, the definition of living apart can get fuzzy, but in two houses is generally what is required. Okay? So that's the first set of rules. Okay, more rules. They have to be fixed or predetermined amounts and payable on a regular or periodic basis. So fixed or predetermined means a set amount, a predictable amount on a regular basis. So it can't be, I will pay for utility bills. Whatever they turn out to be is what you're going to get, because that's not a fixed amount. Okay, it doesn't mean it has to be the same every month, but it has to be predictable. So it might be, for this year you're going to get 500, and then next year you're going to get 550, and the year after that you're going to get this until this year, and it's all going to be cut off. So they can have sort of a table of payments that are going to go up or down over time, but it has to be a set amount that is predictable, that you know you're going to get because you have a document that you can rely on. It's in writing as an agreement or in writing as a court order, and you know what you're getting. Okay, and regular or periodic basis doesn't necessarily mean it has to be monthly, but it has to be more than one, and it has to be over a period of time. So we had a client who came in a particular year, very wealthy client, had divorced their spouse or separated from their spouse, and had given them a large lump sum, which they wanted to deduct as spousal support. Was that reportable spousal support for them? Was it deductible spousal support? It was a single payment, big lump sum. What do you think? Nope. Can't deduct it on the tax return. Not reportable as income on the other person's return, can't deduct it on tax return. This client said it was worth it, can't stand her, happy to have her out of my life. Off we go. Couple years later, comes back in, new partner, not going well, separated, paid another big lump sum payment. We said, why did you do that? You could have just broken it into 3 payments and done it over a couple of months, and then you could deduct it. And he said it was worth every penny to not have to do it for 3 months, because I wanted it to be finished and I wanted to walk away. It happened a third time, got a little bit ridiculous. For that particular client, that was better for him. So there may have been a comment or two in the office of people saying, well, he's a year or two, how much money do you think he's paying them? But realistically, if he had done the same thing, but just said, I will make you, 4 payments over 4 months, it would have been deductible support. It was in writing. He wasn't willing to wait the 4 months, so it was not deductible to him because it was not fixed or periodic. Okay? So that's rule 1. Recipient can spend the money at their discretion. We'll talk about that. The payments have to be made directly to the taxpayer's former spouse or common law partner or parent of the child, with one exception, but we'll talk about that. And then they have to do the non-deductible, non-taxable portion first, and then everything else will be second. We'll talk about that as well. Okay? So starting off, has to be in writing, has to be fixed or periodic. Fixed or periodic means not a lump sum. And Judy, the people receiving the payments did not have to report it as income. It did not show up on their tax returns either, which is nice for them because it was spousal support, which is normally taxable. All right. Now, there's one rule for lump sum payments. If the reason you got a lump sum of money is because there were periodic payments that were supposed to be paid in the past and they weren't, and now they're catching up, either they're catching up because they voluntarily have repaid what was owed, or they're catching up because there is a government organization requiring them to make the payments, so now they're garnishing their wages or assisting in some way. That lump sum payment will still be considered to be support because it should have been periodic. So we're going to treat it as if it was. You're still going to report it in the year you received it. Okay? A lump sum payment, on the other hand, that just say walk away, like the client that we had, is not going to count. Good. Specific purpose and third-party payments. So they're only going to qualify if the person receiving the money is the person receiving the money is the person getting it. So for example, you can't say, I'm not going to pay you, but I will pay the private school and I will pay, insurance for the kids, but I'm not going to give the money to you. That will not count as support unless it is agreed upon, and the person who should be receiving the money has the option of saying, go ahead and do that just for convenience so I don't have to talk to you, but if I want the money later, you have to stop paying it to the school and start paying it to me. So if they have the discretion to say where you're going to pay the money, then it is allowable. But if it's, I'm paying for the private school, but if you take the kids out of the private school, you get nothing. If it's not at the discretion of the person receiving the funds, then it doesn't count as support, and it won't be reportable, and it won't be taxable or deductible. Okay? And the exception, again, to this is payments made through provincial maintenance enforcement programs will still be reportable and still taxable and deductible if they are taxable and deductible, because the only reason they're going through that program is to help with the collection. But how the money gets spent is at the discretion of the ex-spouse. So the ex-spouse has to have the discretion, or the parent of the child receiving child support has to have discretion for where the money is going. Normally, this only counts for things for payments after there's a written agreement in place, but there is a special rule that says if the written agreement says that any payments made prior to that should qualify, they will allow you to go back to the beginning of the year in which you made the agreement plus one more year. And that is to make it possible, because when you are negotiating a separation, you're trying to come up with a separation agreement or a divorce agreement, you're trying to go through the court process, it is beneficial if people can be encouraged to start paying good faith child support payments or good faith spousal support payments in advance, but they wouldn't do it if they knew they wouldn't get a deduction until it was done. And so this will make it possible that you can say, all right, I'm going to pay this much per month now, but then when we put it in writing, I want to be able to claim the deduction for it later. So that's why we have this rule. You can go back, if it says it in the agreement specifically, you can go back, then you can go back to the beginning of that year plus one more year further. All right, we've talked about what's reportable. Now I want to talk about out of the stuff you have to report, what's deductible and what's taxable. So child support, generally, almost always, not taxable and not deductible. It is tax-free to the person receiving it. The person paying it does not get a deduction for it. Okay? There is an exception. If you started paying the child support before May 1st, 1997, and it has never changed since then, it hasn't gone up, it hasn't gone down, it hasn't stopped, if it is still pursuant to the same order and that order has had no changes to it since then it is taxable and it is deductible. That's rare to see now because the child would now be about 24, 20, 23, 24. You might still have to pay child support for your children when they're 23, 24. So it is possible. It's unlikely, though, that you would have an agreement that old that hadn't been amended at least once. So as soon as it's been amended, the old rule no longer applies, and now it's not taxable, not deductible. Okay, so child support, not taxable, not deductible. You're always going to calculate child support first out of the support. The default rule for the government is child support gets paid first and spousal support gets paid second. When did the rule of taxable deductible change? Officially, it changed in 1997, and then there were a couple other changes to things as well after that, but 1997 is when it changed. And then they kind of had this grandfathering in clause, which has been working its way out of the system because we just don't have that many children for whom it applies. Right? So mostly, and if you see someone who has old children and they're paying child support for old children, remember there's a special rule, and that's all you really need to think about here. Okay, so no amount can be deducted for spousal support. Spousal support is taxable and is deductible, but you can't deduct spousal support until after all the child support has been paid. Kendra, do you still have to put it on line 12799? Yes, it is still reportable. It's just not taxable deductible. So that's why I said all the rules apply to what goes on the tax return. Once it's on the tax return, we decide how much of it we have to tax. All right, let's practice. Okay, so I have Gomez and Morticia. In honor of Halloween coming up, they have a written separation agreement. which states that Gomez must pay $400 in child support per month and $150 in spousal support per month. Gomez made all the payments to October when he suffered from a terrible accident, and if you've ever seen the Addams Family, you can imagine what that might have been. He wasn't able to work, so he made 9 payments, and then the end of the year, he wasn't able to make any further payments. I'm going to give you a minute or two to calculate the amount of support that you want to report on lines 12799 and line 21999. What is the reportable portion? What will each of them put on their returns on the reporting number? And then what will Morticia have to claim as income, taxable income? What can Gomez claim as a deduction? So take a minute. If you think you have an answer, give me a check mark just to see how you're doing. We're going to do a quiz. Just want to give you time to do the calculations first. Okay, so hopefully you have an idea of an answer. I'm going to do a poll because we want to get through the answers together. We're going to start with, I'm going to ask you to choose which of these 3 options is correct. So what will we do on the tax return? So A, the reporting lines will report $6,600. None of it will be taxable or deductible until Gomez catches up on the missing payments. B, reporting amount will be $4,950. $150 will be taxable to Morticia and deductible to Gomez. Option C, the reporting amount will be $4,950. $1,800 will be taxable to Morticia and deductible to Gomez. And option D, the reporting amount will be $4,950. $1,350 will be taxable to Morticia and deductible to Gomez. What do you think? Lock in an answer. Okay, I've got about half the class. Be interesting to see how we do on this one because I find the first time you do it, very often we end up doing it in a flipped way. So we're going to see what the results are, how we did. 30 seconds left. See if you can get an answer in. Very happy to see lots of people participating in this poll. Think you have your answer, make sure you hit the submit button. All right, let's take up the answers together. So I will say it is the same thing. Every time I teach this, we tend to flip the order of what we have to do. Remember, child support gets paid first. So when you're doing the answer to this, the amount to be reported is what was received. You always report what was received. What was received was $550 times 9 months. So that's going to rule out option A. Then we have to decide what should have been paid for child support. So the amount that should have been paid for child support was $400 times 12 months. So that has to be paid first. Anything left over after that is spousal support. So I will notice that pretty much everybody did the opposite. You took the spousal support first, you gave Gomez a nice big deduction, but he has not paid all his child support then, which is not what the government wants. The government wants child support paid first. So the correct answer should be B. Flip it around, take the reporting number, calculate the child portion that should have been paid, not what was paid, but what should have been paid. And then if there's anything left over, that will be spousal amount. Okay, so if you got it backwards, that's okay. That's why we're practicing. Then do another question. What happens next year? Gomez is back on his feet. January comes around. He gets back to work. He makes a lump sum catch up of the missing amounts. So he now is going to go pay his entire year for next year because he can afford it. And he's also going to pay the missing 3 months as well. So we're going to do a quick poll for that as well. Okay. If he makes a lump sum payment to catch it up in January of 2022, what will happen on the 2022 return? So option 1, the payment will not be reportable because it's a lump sum and not a periodic payment. Option B, the payment will be reportable and taxable/deductible. Morticia and Gomez should include the lump sum payment on 2021 because that's when the money was owing. Or option C, the payment will be reportable and taxable/deductible. Morticia and Gomez should include the lump sum payment on their 2022 returns because that's when the money was paid. What do you think? What happens to the lump sum catch-up payment amount? If it's reported, when is it reported? Okay, still waiting for about half the class. 30 seconds left to go. All right, almost there. Let's see how we did. Really, really well on this one. So lump sum payments don't count, but if they are catch-ups for periodic payments that were missed, we treat them as if they were periodic payments. When do we report it? We report it in the year it is received, which means in 2022, they'll both have more reported for support for that year because more support was paid in that year. And then Gomez will get a nice big deduction because he's going to have all of his spousal support for the year plus 3 months of last year's spousal support as a deduction. Morticia will have a little bit more taxable income in the year. Okay? Good. Couple of rules generally about support payments. The taxpayer cannot claim a personal amount for anyone for whom they're paying support payments except in the year of separation or the year of reconciliation. So in the year that you separate or the year you become married to someone or common law with someone, there's a special rule where you can claim personal amounts even if you're paying support. The elder-dependent checklist is where this comes into play the most, and it is in there, so read your elder-dependent checklist carefully. And remember, when both parents have to pay support for a child, so the same child is going back and forth, and one pays child support for part of the year and one pays child support for the other part of the year, it cancels out. So that's also on your elder-dependent checklist. Review the rules. We went over that in detail. If you forgot what we did, go back and watch the recording. Remember the exercise we did where we had pictures of houses and complicated families, and you can see all of the different examples of what we did there. Okay. Briefly, legal fees. We talked about legal fees before. Just a quick reminder, legal fees can be claimed on line 22100 if they were paid to collect late support payments, establish the amount of support payments, or obtain an increase in support payments. They do not count if you're trying to make support payments lower. If you're trying to eliminate support payments, they don't count for child support. Okay, and they can't be mixed up with other custody or asset splitting things. So if you are also deciding what to do with the house and the retirement funds, and you want to know which kids are going to be where for Halloween and which kids are going to be with who for Christmas, those fees will not qualify, only the ones specifically related to establishing a spousal amount or a child amount, a spousal support amount or a child support amount, or increasing or collecting. Those ones, yes. All right. I'm going to take a break there really, really quickly. It's 11:14. Let's come back at 11:19, and then we're going to see if we can finish this chapter in the last section. So take a quick break here, and we'll talk about the last few things. Okay, welcome back after the break. Let's see who's here. Give me a check mark. Let me know how you're doing. Make sure everyone is back in. All right, we've got a few. Hopefully everybody else will catch up with us. Adoption expenses. So lots of difficult stuff we've talked about. We're going to do an easy one now, and that's adoption expenses. Remember, in Manitoba, we have some additional refundable credits if you are having fertility issues. So does anyone remember what the fertility credit refund maximum amount is? What is the maximum amount of the refund for the fertility credit? We talked about that last class. It's provincial. Remembers? You can claim a portion of the fertility treatments that are incurred in Manitoba, up to 40% of a maximum amount, $8,000. So that's what happens if you have fertility treatments. But there are other times when you might incur costs in order to have a child, and that comes from adoption. So we also have a place on the return federally for adoption expenses. It is an additional non-refundable credit. Non-refundable credit starts with a 3. Nothing has changed since the beginning of the course. The maximum amount per child is $16,729. What's different about this one is you don't claim it in the year necessarily that you incurred the expenses. You claim all the expenses related to the adoption that are eligible when the adoption is finalized. So in the year the adoption happens is the year when that will show up. What is eligible, the textbook is excellent on this. It's going to show you that it's your legal fees. There may be some travel fees. There may be some fees for going to court as well, or agency fees, things like that. If it's on the list, you can claim it. If it's not on the list, you can't. Use your book to help you with that to determine. And then you can have more than one child that you adopt, possibly more than one in a year. If that happens, you can claim more children for the adoption expense, but you can't go over the maximum per child. And you can split it between yourself and your spouse. So it has to be split by someone who is the person who paid the fees and adopted the child, or their partner, but you can split it if you want, as long as you don't go over the maximum between the two tax returns. So that's adoption expenses. Remember, some provinces will have an adoption expense. If they do, it mirrors the federal one. So if there's a provincial one, I'm going to leave it up to you to find that one. I'm going to go over the really complicated ones, but if there's a provincial credit related to this, just keep in mind, look for it on the form. If you see it on the federal form, if there's a matching provincial one, go find it on the provincial one. All right. Next big thing, pretty much last big thing today, childcare. So lots of people pay for childcare. Everybody will bring you their childcare receipts. It is very important to remember, not everybody gets to claim childcare on a tax return. Some people do, some people don't. So first you have to determine if your client can claim childcare. If they can, then we have to find out which parent, if there's more than one, will be claiming childcare, and then we're going to fill it a T778. So I'm going to go through all the rules, and then we're going to look at the form itself, because the form helps us to understand what the rules are. Okay? So you've determined if you can claim it, who can claim it, how much you can claim. Fill out a T778, and that is a deduction. So it takes income off before we calculate tax on line 21400. So you can only claim child care for a dependent child whose income is less than 13,808. So they have to have low income. If they have high income, they're not a dependent child because they can pay for themselves. It also includes children under 16 at some time during the year, so they have to have been under 16 while they were receiving the child care, and they can be 16 at the end of the year, but then the next year they won't qualify. Or, alternately, you can include older children if the child is infirm. So if you have a child who's infirm, who is dependent on you, you can claim child care for that child. Now, from a practical standpoint, because I get asked this question every year at some point, so I'm going to anticipate a little bit here. From a practical standpoint, an adult child who is infirm and requires assistance is probably going to have an attendant rather than a care, like a child care scenario. So in many of those cases, they're going to age out of having a daycare or a babysitter or the types of things that qualify from child care and transition to what is more appropriately classified as attendant care, and you've learned how to deal with attendant care. But there may be a few times when they would qualify for child care, so you can always factor that in if it's appropriate. More commonly, it's important to establish the limits. So as long as your infirm child is residing with you and dependent on you. So residing with you and dependent on you, and their income is less than 13,808, they will qualify as a child who is eligible for child care on the form, and that will become important as we go through the form. Okay? So children under 16, at some point during the year, if they're 16 or older, they have to be infirm. Okay. What can you get child care to claim against? You have to claim it against some type of earned income. I'm going to put a little star on that, and we're going to come back to the idea of earned income. But generally speaking, the purpose of a child care deduction on the return is to allow you to go to work. Or, if you're a student, to allow you to conduct research for which you are receiving a grant. So those are the two things you have to have for earned income. You have to have work, or you have to have research. Generally speaking, going to look for work does not fall under this category. So in most years, and this is the rule you need to remember, in most years, EI does not count as earned income for calculating child care. Does anyone know what the exception is? Which years is that not true for, and why? So there are 2 years where you can include EI as earned income for this. It's because of COVID, and it's the tax years 2020 and 2021. We have not seen any indication that it will be true for 2022. So we're going to have to wait and see. In 2020, we were told that it would apply for 2021. We have not yet heard that it's going to apply for 2022. So it's entirely possible that it will quietly go away in the next budget. Or it might be that if they try to take it away, people will kick up a really big fuss and they're going to decide to keep it. We don't know what's going to happen yet. But I want you to learn the general principle that EI does not count unless there's an exception. And 2020 and 2021 are the exceptions to that. There's one more exception related to EI, which is true for all years, and that is if the reason that you have to pay for child care while you're on maternity leave is so that you can maintain a spot so that when you are ready to go back to work, you're able to. So there is an exception for that particular circumstance where you can do child care even if your income is only from maternity leave in the year. But that is the only other exception. So generally speaking, earned income will be income you earn from work or from a research grant. It will not include needing child care because you're going to job interviews or you're retraining or you're doing things like that. Okay? So you can claim expenses incurred to allow you to attend school. We're going to talk about school as an exception. And then we're going to talk about the other Part C exceptions as well. So there's two special rules there, but generally speaking, you need earned income. Okay. What can you claim child care expenses for? So there's a whole list. They're going to fall into one of these categories. So babysitting, daycare centers or pre-kindergarten, other educational institutions if the receipt says childcare. So if you look at your textbook, it's really excellent on this section. The textbook will tell you that certain things don't qualify. So providing food doesn't qualify, providing tutoring or educational opportunities doesn't qualify, but actual childcare, supervising children because you can't be with them, does. So you'll find that some schools, especially some private schools, will have a lunch program or they'll have an after-school program which might have a portion that is food and a portion that is supervision, or in the aftercare they may have a portion that is training and tutoring and a portion that is just supervising your children until you can pick them up. Those schools are usually really good at giving you receipts with a breakdown on them. So the receipt will tell you this is the portion that's eligible for child care, and that's the portion you can claim. But you will have parents who will bring you their school fees, and they'll say, I want to claim my school fees because I pay for all of these extra services at my school, and those will not count. Okay? Day camps, day sports schools, if child care is the primary goal. So that becomes important when you get into whether or not they're going to that camp because you need them to go to the camp so you can go to work and you have to keep them occupied in the summer. Or maybe it's not the case. Maybe they're going to the day camp or the sports school because they're really, really good at hockey, and we live in Manitoba and that's very important here, and you're getting them extra special training. That will not count as childcare because it's not childcare. It might count as something else in Manitoba, and we'll talk about that at the end of the course when we have time. Okay, so day camps or day sports schools if childcare is the reason that your child is going to the day camp. And again, it will be limited to certain things, and the receipt will usually have the information what you can claim. And then boarding schools and overnight camps do count even though they have a lodging portion or a hotel portion or food, that kind of thing. It will count because it's limited to what you can claim. So you'll take the whole receipt, and on the T778, you're going to limit yourself to an amount per week for each eligible child. So every child who's disabled, $275. Every non-disabled child under 7, you get $200 for the camp, and every other eligible child, so not disabled and not under 7, you get $125 per week. And that will be the maximum you can claim, no matter what amount is on the receipt. So either the amount on the receipt or the limit per week, depending which one is smaller. Okay. I'm going to show you the T1178 while I'm doing this because I actually think it might be helpful to see it as we go through the sections. I'm going to open one up here, and we're going to talk about what we've already talked about, which is list the children first. So you're going to put all the children here, and again, it's really important to make sure you include all eligible children, even if you didn't have child care expenses for that child in the year. Put them on the list anyway, and I'll show you why in a minute. So you're going to list every child who was eligible, so they're 16 or under, or if they're over 16, they were disabled or infirm. Then you're going to list the payments. You're going to notice if it's a boarding camp, you're going to say the number of weeks and limit it to the number allowable per week. If you're putting in what type it is and it's a babysitter, you have to put the social insurance number of the babysitter. Why does the CRA require the social insurance number of the babysitter? If they're going to give you the deduction, what do they need to see? They need to see who is supposed to be claiming the income. So if you have an informal arrangement and they're giving you a receipt and they don't have a SIN number on it, go get a SIN number. These get audited a lot, and they will not be allowed if you don't follow the rules. So if it's a babysitter, you need a SIN number. If it's a daycare or a sports camp, you don't, because that's not an individual. It won't have a SIN number. Okay. And then you're going to say, out of those expenses, how much was incurred for a child under 6? That's just a reporting number. They want to see that number. It might be used in other calculations later. Then we do the limit. This is why you want to include children even if they didn't have childcare that year, but they could have had childcare that year. The maximum you can claim in childcare is going to be one of three numbers, whichever is the smallest. So number one is how much you actually paid. If you paid for it, that's the most you can claim. Limit number two is this section, which is total up the amount per child. So if you only have one child who falls into the category of born between 2005 and 2014, or born in 2004 or earlier with an impairment in mental function for whom they can't claim the disability, so that's an infirm child over 16 or a child between the ages of sort of 7 and 16, you get $5,000 per child. If they were born in 2020 or earlier and they have a disability, you get $11,000 per child. And if they don't have a disability, but they're born and they're 6 or under, you get $8,000 per child. That's the next maximum limit. So you're going to add those together and you're going to see which number is smaller, the amount you actually paid or the limit. And then the third one is earned income. We've talked about earned income. You have to include your earned income here and you get 2/3 of it. The maximum you can claim is 2/3 of your earned income as a deduction. So you're going to get all three numbers, pick the smallest one, and that will be your allowable deduction. Okay, we'll come back and talk about the rest of it, Part C and Part D next. I want to talk a bit more about the payments though. So you can get a receipt for childcare and claim it if the person that you are paying is a resident of Canada and they are not the father, mother, or supporting person of the child that's being babysat. They're not a child or brother or sister if that person is under 18. And they're not someone for whom you or another supporting person is claiming a personal amount. So that one becomes relevant when you have elderly relatives. If you're claiming a caregiver amount for an elderly relative, and that elderly relative is also providing childcare for you, and you're paying them, then in that circumstance, you don't get to do the childcare deduction because they're a dependent. So the fact that you're paying them means you have to pick. Do you want the child care expense or do you want the caregiver amount? Okay. If there's more than one supporting person, this is important. If there's more than one supporting person, the expenses must be claimed by the one with the lower net income unless there is a Part C exception. We're going to talk about Part C exception, but in all other circumstances, it must be claimed by the person with the lower income. So what would happen in a year where you have two parents, and let's say a year before 2020, just to make life easy. So this is before the pandemic happened. You have two parents. One of them has a high income. The other one lost their job and they've been on EI for the whole year. And they have low income because they only had a little bit of EI income. Who can claim the child care in that scenario? There is no Part C exception. What happens to the child care? The higher income person can't claim it because they're the higher income person. The only person who can claim it is the lower income person when there's no Part C exception, and there isn't one. The lower income person can only claim it against EI income, and that against earned income, and earned income does not qualify. There is no child care deduction for that family in that year. That's something that people really struggle to understand because they did need the child care. The child care was necessary, but they do not get a deduction in that circumstance. Now, for 2020 and 2021, they would get it because of the exception that said that EI will count as earned income in those years. 2022, as far as we know, that won't apply anymore. So just because the lower income person can't use it doesn't mean you can give it to the higher income person. It only means you can do that if there's a Part C exception. So we'll talk about that. If there's no Part C exception, you're only looking at the lower income person. If they can't claim it for whatever reason, it's gone. It's lost. Okay? Get really comfortable with that idea. It's hard to explain to clients why they can't claim their child care, but in that circumstance, they can't. Okay? And then a supporting person, in this case, we've talked about supporting person has lots of definitions. Who is a supporting person? Who can claim child care for a child? They are another person who resides with the taxpayer at any time during the year and at any time within the first 60 days of the next year, who is also a parent of the child, or the taxpayer, spouse, or common law partner, or any individual who claimed personal amount for the child. So if any of those categories follows, then that person, if they're the lower income person, can claim the child care expense. Okay. Part C exceptions are very limited. So this is the only time when the higher income earner can claim some or possibly all, depending on the calculation of the child care expenses. It is if the lower income person is attending school, either part-time or full-time. We'll talk about attending school in the next chapter. But if they were attending school part-time or full-time, then there's a Part C exception. If the partner was infirm and confined to a bed, wheelchair, hospital, or other similar institution for 2 weeks, I've added a star that's not in your notes. The star is important. Or if they're incapable of caring for children because of mental or physical infirmity. Both of these conditions, in a hospital, confined to a bed, confined to a wheelchair, also requires them to be incapable of caring for children during that period of time. That is not true for everyone who is infirm. It is not true for everyone with a disability. It is not true for everyone in a wheelchair. Just because you have a disability does not mean you can't care for children. Be very sensitive to this. So we've had situations where an inexperienced tax associate will look at someone who is the parent of their children, and they might be the lower income spouse, and the person, and they might be blind, they might be deaf, so hearing impaired, visually impaired, they may have a wheelchair. You cannot say to that person, because of your disability, you can't care for your children, so we're going to give the child care expenses to the higher income person. Congratulations for you. That is not appropriate and would not be allowed if it went through, because they are capable of caring for children. On the other hand, someone who is not normally in a wheelchair, who breaks their leg and then is in hospital for 2 weeks, and then when they come home, their house is not accommodated for a wheelchair, they've never used a wheelchair before, and they have children in the house, they can't care for their children in that circumstance. That's what the Part C exception is for. Okay? Or if they have a mental or physical infirmity that is so serious that they are not able to care for their children, in that circumstance, the Part C exception will apply. But it is not automatic that if you have a disability or you have a medical certificate so you qualify for caregiver or something like that, it's not automatic that the Part C exception applies. It's only if you can't care for your children. Okay, be careful about that one. All right, or, so the easy one, if they were in prison for at least 2 weeks, the Part C exception will apply. And then the weird one, if they were separated for a period of at least 90 days that included December 31st, so the 90-day period has to include the end of the year, but they got back together within the first 60 days. In that case, you will have a scenario, which is Part C, where if the higher income spouse was caring for the children at the time and they had to be in child care for work purposes, in that case, the Part C exception will apply. Okay? You can see all of these on the form itself as well with detail. So if there's a Part C exception, the higher income earner will fill out the first T778. They're going to fill out the first section. They're going to get to Part C. They're going to include the name of the person with the lower net income, their insurance number, and the net income number. They're going to tick off how many of these boxes apply. Usually it's just one. And then they're going to enter the amounts depending on what it says. So you can enter the amount from line 4 in Part B, and then you're going to take that number and multiply by the number of weeks where they were B to F for the scenarios, the number of months where they were A is part-time, so number of months part-time, the number of weeks for everything else. And then that will determine their allowable deduction based on the same rules. They still have to have earned income. They have to have the limit for the children. It'll be 2/3 of their earned income, the limit of the children, and the total child care. Determine what they're eligible to claim. If there's anything left over, what can you do with it now? So the higher income earner can claim some of the child care, but not all of it because of the limits. What is the next thing we do? Put it on the lower income. So then You're going to finish this return, put it on, then the lower income person is going to go back to the first page, fill it out for themselves, and you're going to notice there's a section in here that says enter the amount the other person has deducted. They can claim the remainder if they have earned income to claim it against. So don't lose it, don't waste it. Give it to the lower, give whatever's left over to the lower income spouse. Okay? And then there's one more exception at the end that you need to know about, which is Part D. Part D is what you do if you were the only supporting person and you were in school. So if you're a single parent who's in school, in that case, you don't need to have earned income. You only need net income. So people who are in school and they're single parents can still claim child care as a deduction against the income that they have on their return, even if they don't have earned income. And Part D is also there if both the higher income and the lower income person were enrolled in school, if both of them together. So you're still going to fill out Part C in that case, and then that you can fill it out based on net income, not based on earned income. So the form itself seems a bit complicated. Remember, the exceptions for Part C apply, and there's a second exception if everybody's in school, if the people looking after the child, if there's only one, or if two people are both in school, there's a Part D exception. Okay. Receipts we've talked about, so I'm not going to do that. It's in the slides. We've talked about the form. That's in the slides as well. We're going to do a really quick activity. Because of the timing, I'm just going to give you the answers for this really quickly, but you're going to have the slides. So I want you to go back on your own after class, and I want you to see if you can come up with the same answers that I did. So Bill and Karen are divorced. They're the parents of one child who is in Bill's custody. In order to work, Bill pays Karen to care for the child. Assuming Karen doesn't reside with Bill, they're separated, can he claim a deduction for child care? If he's paying the receipt to a parent, no, because she's not babysitting, she's parenting. You don't get a deduction for parenting your own child, even if somebody pays you to do it. Okay. Mandy is a single parent who works most nights. Because of this, she pays her neighbor for letting her 15-year-old son spend the night and for feeding him dinner and breakfast. Can she claim it as a deduction for child care expenses? Yes, because her son is 15. If he was over 16, so if at the end of the year he's 16, that's okay, but if next year he's 16 turning 17, it would be no. But 15-year-olds are eligible, so she can claim it. She needs a receipt, and she needs her neighbor's SIN number on the receipt. All right, Jake and Ann are common law partners. Gary is Ann's 3-year-old child from a previous relationship. Jake paid a daycare center $6,000 during the year so he and Ann can go to work. Can he claim the deduction? Here you have to say, is he a supporting person under the definition for child care? Supporting person under the definition for child care is the common law spouse of the parent of the child. So yes, he qualifies. The next question we have to ask is, who out of Jake and Ann can claim it? And for that, we need to know who has the lower income. So if Jake is the lower income earner, the answer would be yes. If he's the higher income earner, in this scenario, the answer would be no, unless there was a Part C exception or a Part D exception. So that's a very complicated answer to this one. All right, Mary's a single parent. She paid her 19-year-old sister, Michelle, to look after her 2-year-old daughter so she could work. Can Mary deduct child care expenses she incurred? She's paying it to a sister, but her sister is 19. So in this case, yes. What if her sister was under 19? In that case, would she be able to claim it? This one I'm going to ask you guys. If she's paying her sister and her sister's under 18, no. So in that case, it would be no. In this case, it's yes. And of course, Mary needs to declare the income on her tax return. So you need a receipt and you need a SIN number. All right, Joan is a single parent. Her only income is from EI. In order to upgrade her skills, she went back to school full-time. While she was in school, she paid her neighbor to look after her 2-year-old son. Are these child care expenses deductible? Yes, for a number of reasons. So the big reason is because she was a single parent in school. The Part D exception applies regardless. So because she was a parent whose income is from EI, but she's in school full-time, Part D applies, and she can claim it against 2/3 of her net income. What if she wasn't a student and it wasn't 2020 or 2021? So if it was 2019 and she wasn't a student, in that case, if she was on EI and looking for work, no. So that would be the rule. If it was 2020 or 2021 and the only income is EI and she's not in school, it would be allowed because of the exception they have because of what happened with COVID. And we'll find out for 2022. At some point in January or February of next year, we'll get the budget. All right, that's childcare. You do need to practice childcare. We have about 12 minutes. One more difficult thing, not really difficult, just summarizing what you should already know, but I need to organize it for you, and then some really easy things, and we're done this chapter, okay? So hang in there. Let's get this done. So we've learned about a lot of credits, personal credits. We've learned about deductions, support, all of those things. They interact with each other. So each line has its own rules. You're going to do each line separately and find out what's possible. And then at the end of the day, you're going to have to go back in and see which things cancel each other out. So sometimes if you claim one thing, you can't claim another one. Find out all your options first. Identify what restricts you from what, and then pick the best scenario. So you're going to have to practice this a whole lot. It feels scary because it seems like everything is possible, and remembering what interacts with what can be difficult. So there are a couple of rules about spousal amounts. Spousal amounts, we know from doing it before, the year of marriage starts, you get a spousal amount based on your spouse's net income for the whole year. We've practiced that in class. So if you have a spouse at the end of the year and you want to claim a spousal amount, all you need to do is know what the spouse's net income was, reduce it on Schedule 5, and that becomes your spousal amount. You can, if you want to, claim a spousal amount in the year of separation. It's calculated differently. So in the year of separation, instead of looking at your ex-spouse's income for the whole year, we only need to look at your ex-spouse's income up to the date of separation. So is it better to separate at the beginning of the year or at the end of the year? If you have a spouse and you earn income, is it better to claim at the beginning of have to break up at the beginning of the year or the end of the year, assuming you're both working? Always break up at the beginning of the year, because at the beginning of the year, on January 3rd, your spouse will have probably earned zero income by January 3rd. They might earn $50,000 by the end of the year. So if you're going to break up over the holidays and you want to do it in a tax advantage way, wait until after New Year's and break up then. That's a joke. Never plan your real life based on tax. But just to keep the idea in your head, when you're claiming a spousal amount in the year of separation, you're going to take the income earned by your spouse up to the date of separation only. Okay? However, two people can't claim the spousal amount for each other. So in the year of separation, if both people were working and both people, they broke up at the beginning of the year, there are two possible spousal amounts, but you can't each be a dependent spouse for the other person. So you're going to have to make sure you know who's claiming it if you're going to do spousal amount. There are lots of other things you might choose instead of spousal amount. So it's not always automatic that you want to claim spousal amount, but you can. You have to be able to find out what their net income was before that period. That can be tricky if you're not talking to them and they were working for part of the year. We'll talk about that in more detail when we get to the actual computer software and we have to calculate it for real. For now, your cases are going to tell you what the income was, okay? You also have to choose in the year of separation between claiming the support payments if you have deductible support payments. So if you have deductible child or spousal support payments, then you have to choose between claiming that or the spousal amount. You can't claim both. Okay? So that's how those things interact with each other. Eligible dependent in the year of marriage, if one spouse or common law partner supported a dependent prior to the change date, that person can claim an amount for eligible dependent. You know this from before. go back to what we talked about. If you were a single parent for part of the year and then you became married, you will have a choice then between claiming elder dependent or spousal amount. Can't claim both, but you can pick one or the other. Okay. It's not possible for a taxpayer to claim both the amount for spouse or common law partner and elder dependent. Pick one. Pick the better one. Factor in if someone else is going to claim the elder dependent, then you can't claim that one. Then you claim the spousal amount. Put all the options on the table, rule out the ones that don't apply, and then see how the other ones interact with each other. What is the best that I can get out of whatever's left over? Okay. There's a weird rule where it's possible to claim a spouse or common law partner amount for one person as an elder dependent, and someone else claimed the same person as a spouse in the year the status changed. That would happen. There's a really good example in the book about it. If you have, say, a single father with a young daughter who gets pregnant, the boyfriend moves into the house with them. They're all minors, so they're all under 18. So he has a minor daughter in the house under 18. Her boyfriend moves in. She has a baby. Now she has a common law marriage. In that 1 year only, the father can claim her as an elder dependent, and the boyfriend or the father of her baby can claim her as a spouse just for that year. The year after that, he will not be able to claim her as an elder dependent because in that year, she has a spouse for the whole year. Okay. There's an example of that in the book. Okay. Amount for elder dependent separation. A short period of separation might allow a claim for an elder dependent, but they can't be supporting each other unless it's by a written agreement, which usually doesn't happen. If you break up temporarily with someone, you usually don't put in writing what the agreement is going to be and have fixed and periodic payments and all that stuff. So if you don't put anything in writing when you leave the house and you're still helping with the bills, you're not going to have an elder dependent. That's what usually happens. Okay. And then in the year of a status change, you can claim an amount for elder dependent when deductible support is being paid, but you have to choose between the support deduction and the credit. That doesn't really apply anymore because child support, usually when we're doing elder dependent, we're claiming a child because we wouldn't be claiming a parent. It wouldn't make sense. If we're claiming a child, remember, child support's not deductible unless it's that weird rule from before 1997. So this last rule, I wouldn't spend a lot of time worrying about. All right. That's how they interact with each other, and you are going to have to practice it. I have one more thing I need to tell you, and then we're done for today. So I'm going to do that, and then I'll stay a little late if you have more questions after class. Okay? I want to talk about what happens to your benefits after you separate. So after you separate, you need to tell the CRA about your marital status change. That happens all the time. Separation, people tell the CRA right away. They want the CRA to know that they're separate because they think they're going to get more benefits, which they usually do. Okay? You have to do it after 90 days. We know that already. The GST credit and candidate child benefit will be recalculated according to what you tell them about custody. So after separation, if it's just spouse, then they'll recalculate it based on your income and they don't need any other information. But if you have children, then they're also going to want to know who has custody of the children, and you'll have to send them any agreements you have about that. If you don't have an agreement in writing, you have to give them some kind of evidence. The best thing to do is to get a statement from each parent saying this is where the children are living. It's not going to affect anything from a family law perspective, but it is going to be useful for tax. Or more commonly, they will have a separation custody agreement, or they'll have a court order custody agreement. So they'll agree to custody in writing, or they'll go to court and have custody sorted out there. They will then file that with the CRA, with the RC66, and that will determine how the children get handled for GST benefits, for climate action incentive benefits, and for CCB. So everywhere you see on these slides GST and Canada Child Benefit, for Manitoba, add climate action incentive because the person who has custody of the children is the one who will get climate action for minor children as well. There's a special rule for shared custody. So in shared custody situations, this is much more common. Shared custody for the CRA counts as each child living with each parent in separate locations on an equal or near equal basis. We don't determine what that is. The CRA determines what equal or near equal is. It does factor in the reality that you might have a reason why it's not exact 50-50. You might have one parent for the school year and then one parent on weekends and for the summers. That might turn out to be equivalent to equal, even if the actual number of days isn't. We don't determine that, the CRA does. But if it's shared custody fundamentally, and that's what the agreement says, you need to notify your client that what they're going to get for benefits, so CCB, GST credit, and I've added into the slide for you climate action incentive as well. This is new, climate action incentive. They've changed the rule for 2021 and ongoing. They're going to treat it the same way. They're going to calculate the amount as if the children were in each home. So they're going to look at parent number one and the children in that house and that parent's income, calculate it as if that parent was a single parent, and give them half of whatever they would get. Then they go to the other taxpayer, look at that person's income, assume the children are with them for the whole year, calculate what they would get as a single parent, and give them half of it. So what that means for Canada Child Benefit is if you have one separated parent with shared custody who has very high income and one parent with shared custody with very low income, the low income parent will still qualify for CCB, but they're only going to get half of what they would have gotten if the other person, if they didn't have shared custody. If they were a single parent, they'll get half. If they're a single parent, they'll get all of it. If they're shared custody, they'll get half of what they would have gotten. The other parent isn't going to get the difference. They're going to get nothing because their income is too high. So they're going to look at their income and go, you don't qualify for CCB, and that'll be the end of it. Okay, that's how they do it. We don't do that. What can you do if your client isn't getting what you think they're supposed to be getting? So maybe you have a parent who has a shared custody and they haven't been receiving GST for their children. They haven't been receiving Canada Child Benefit. What advice would you give that person? What form should they be filing with the government to let the government know what their custody scenario is? File an RC66. Tell them to file an RC66 with documentation to prove that they have shared custody, and that will update the records. Now, from a real world perspective, tell your client that when they do that, they have to think about it. What happens if you have shared custody but you haven't been getting Canada Child Benefit and your ex-partner who doesn't like you has been getting all of the Canada Child Benefit? And you go to the CRA and you prove that you should have been getting half of it. What will happen to the ex-partner? They have to pay it back, which is good news for you, but possibly not good news for your children who are in the middle of a big custody situation. So you have to factor in whether or not it's worth it to do it right now. Have them talk to their lawyer about what they want to do for this. If they have a lawyer, make sure they're aware that if they have a big consequence that makes the other person really upset, they need to decide if they want to take that on for themselves and their family based on what's happening in their life right now. So it's not always something, we don't always get everyone the maximum benefits if it's going to make things worse for their actual life. But many times they do want to get the CCB and they know that the other person's going to have to pay it back, and they'll work that out. We can help them file an RC66. Okay, that's it. We're done. Finished class. Okay, there are 2 more slides. You can answer those ones on your own. I can refresh them in the beginning of the next course if you want, but we're going to stop there.